right, so what do you got there? Setting targets. Setting targets is what we're going to talk about now. And I love targets because it's the one part of trading that nobody ever really seems to, it's more subjective than objective. Entries are objective. You know, we talk about prior bars highs or bottoming tails or topping tails. Stops are very objective using prior bar information or moving averages or any of the ways that we break out bars, any of the ways that we determine stops. But then there's the unknown targets. So you buy a stock. Let's say you take a moving average buy setup. The stock pulls back to the moving average. You buy it, and it starts to go up. And then you say to yourself, okay, well, where do I take a profit? Do I take a profit just because I feel like it? Do I take a profit because I've made enough? Do I take a profit because it's up 3% today or 7% today? Do I take a profit because because I'm green, my P&L is green? These are the questions that I think a lot of traders, constantly battle, because this is the most important part of the trade, in my opinion, the target. Setting targets is important because it's part of every plan to maximize risk and reward. Without optimizing your risk, without optimizing risk-reward for every trade, it's difficult to come out ahead in the long run. Without having a target for each trade, you run the risk of letting winners turn into losers. Now, we say as a rule of thumb, traders like to identify trades with a target that is at least twice the distance of the stop loss, which is basically what we're saying is if you're risking X, let's call X 50 cents for lack of for argument's sake, then we like to have a target of at least $1, 2 to 1. Okay, that's basically what that says. Now, there are different ways to measure or determine targets. We've talked about the chart pattern way, which is where a pattern has a predetermined distance, and that distance should then repeat itself in its outcome. We talk about Fib extensions yesterday. We briefly touched on Fibonacci extensions and using that tool as to measure distance. And then there's the third part, which is sort of the, which is what a lot of day traders do, which is the candlestick analysis or bar-by-bar methodology, which is really letting the candlesticks tell you when it's time to get out versus you trying to figure out where to get out or where it may go. A lot of times a trader will put on a price target. They'll buy a stock at, let's say, 50. Their stops will be at 49. Their profit targets will be at 55. Well, the stock runs to 53.5. It doesn't quite get to 55. They don't sell it, and next thing you know, the stock is back at 50, or they've been stopped out at 49. So setting a target, as good as it may be, and it's part of every plan, is not an exact, and it is subject to change should something change. So that's where bar analysis comes into it, and we'll talk about that. Well, let's look at the examples of targets and let's see if that answers your question. So we have support and resistance. Okay, this is one example of targets. So what we do in this example is we look left. So on the chart to the left here, what you have is we ask the question, where is this going? You have your buy setups on your moving averages. This is a daily chart. You have a buy setup here at a moving average. It tails back up. You buy through the prior bar's high at the moving average, and you have another one over here, and you say to yourself, well, where is this going? Okay, based on the data here, what can you determine about resistance? Where do we know minor resistance lives in this particular chart to the left? Resistance. Resistance would be, as far as we know, right here at the top of this bar, which is where sellers came in and pushed the stock back down. So we would use the top of this bar, which we call, let's say, 38, as our potential target. But now the chart on the right, what I've done is I'm looking at the same chart, I'm just looking at more information. So if you look at the chart on the right here, we call target 1 is the prior high resistance, and then as we look at more data, it's again the same chart, we're just looking at a larger sample of time. We can also see up here where these tails were is obviously another area of resistance, as this is where the stock had rallied into previously and then sold off. So we're going to call that target 2, prior high resistance. So in this particular example, we are using prior historical information to make decisions about future price movement. Resistance over here, there was obviously sellers up here that caused the stock to have this large move down. We suspect that those sellers might become apparent should that level get tested again. Okay, so we're using prior support or resistance. Okay, the chart to the left, we see a buy setup. Where is this stock going? It's a 5-minute execution chart. Okay, based on the information you see here in the 5-minute chart, we know that we have a prior close up here. The stock gaps down. It rallies back. Where do we think it's going? We know we have our prior close, which again to the right, prior high resistance. That's the same place. We also have again up here a very sneaky. It's a 200 EMA. Okay, so we have 200 EMA resistance at prior high resistance, and again more data shows you more information. Back here we can see prior lows. Again, this was support. This was support. It was broken. It rallied back. It acted as resistance, and we suspect it'll act as resistance again. Using more information to make value decisions on support and resistance. Very, very important. So in this instance, we know exactly, even this is a 5-minute chart, we get our buy set up, a pullback into the moving averages that have gone bullish. Our stops will be down here at 118. We buy through a prior bars high, which is where this dotted line is. We are risking very, very little, maybe 10, 12 cents, with a profit objective up here at 118.40. So you're risking about 12 cents or whatever the numbers are to make about 30 cents. Okay, so good risk reward, 3 to 1. So on and so forth. Notice in every example, before I continue, notice in every example that all of our buy setups and sell setups are coming off of pullbacks or bounces. You'll never hear me once talk about chasing a stock up. If a stock is rallying and you haven't bought a pullback and you chase it, all you have done is dramatically enhanced your risk. It's very, very important you get comfortable buying pullbacks. What that means is you have to be patient and wait for that pullback. If you are impatient and you start buying price because it's rallied 30 cents and you're afraid, or 50 cents or $1, and you're afraid you're going to miss the next dollar, you may miss the next dollar, but the truth of it is you've dramatically changed the landscape of your risk-reward objectives by chasing price. Get comfortable buying pullbacks. It's very, very important. It will dramatically affect the results in your trading. Targets, again, the chart on the left, we have a sell setup on snapbacks into the 21. The chart on the right, so we have identified where the sell setup is. The chart on the right shows, again, all we're doing is looking at more information. What are we doing here? We're doing time frame analysis. We're using our daily charts or our larger time frames to determine where prior support is. You can see in this picture, pivot low support. There is obviously a level of demand that has happened at this price multiple times. If we know that at $15, which is where this price level is, there's a lot of support, I want to be very, very cognizant to understand that if the stock is trading at $15.20, even though it's on a sell setup, I have to be careful because only 20 cents below or 30 cents below is a very big area of support that may cause a turn in this stock. What am I doing? I'm using 2 time frames to make tradable decisions. I have a sell setup here. at $15.30, whatever the price is, $15.30, which means that there may be a good trade here, but I have to also be aware that down here is a much more significant area of support that causes tails every single time or causes a change of direction. It's not the question of whether it's a good trade or a bad trade, it's just using your information to make tradable decisions. Okay. If I was short at $15.30, I would have a target of what? Probably $15 in the low 15s as a target because I know that's what demand for the stock is. Now, the Fib Extension Tool. And this is going to take a little bit of time to get used to, okay, because it's probably something a lot of you are not familiar with. In the picture to the left, I have a chart that gives you basically a buy setup. You can see a 1, 2, 3, which is basically a move up, a directional move up with a pullback into support. Now, again, this is a weekly chart, so you know the time frames, for argument's sake, irrelevant here. But you have a pullback that gives you a buy setup. It pulls back, and you can see that big green bar that thrusts up, takes out a prior bar's high, weekly buy setup. And again, you can see what we've done is we've measured the first distance, which is the low, which is the chart on the right, the low to this high, and then the pullback to here, and we have these extension levels that follow. You can see a 62% extension, a 100% extension, and so on and so forth. And we'll continue to look at this. So, again, you have a directional move down that bounces back into the declining moving average. We get a sell setup, same chart right here, and I can look at the directional move down, the bounce, and then I have targets as what we call extension levels of this first move down. So these extension levels are basically predetermined measured distances based off of this first move down. Okay? Just like a Fibonacci retracement, it's an extension. Instead of us saying, well, how far back is it going to go? What we're saying is, how far forward is this going to go? You start it from the top of the first move to the bottom of the move. So if we're looking at chart 1, it would be the highest point to the lowest point. So it would basically be 1 down to 2. Now this is something you're going to have to play with and get used to, because it's probably new to most people. Well, yeah, I'll show you my e-signal how I do it. I don't have to actually do anything except press the button, but being able to understand how to look for it is sometimes foreign. So let's go and let's bring up my e-signal and let's take a look at some of those type of situations that I think might make sense. I'm going to bring up a stock, fairly irrelevant as to what the stock is. Let's look for what I would call a perfect example of a setup that I think makes sense. So what you have here on this time frame is declining moving averages. You can see the stock breaks down, right? Snaps back into the 8, also now under its 200, and continues its descent. So the question is, where is this stock going to go? So I take my little tool and I say, okay, well, I'm looking at this stock. I can see that it's broken down. My moving averages are declining. The 8 period has control of the stock. I enter the trade where? I'm a day trader. Where do I enter this trade? I enter it right here. I'm going to make this darker. I'm going to make this darker. right here is where I enter this trade. When this bar takes out this bar's low, I have a snapback into a moving average, tail down. This bar takes out that low. Right? You see what I have here? I have it's a bear flag. My stops would be up here. Does everybody see that? It tails down at the moving average. Once this bar takes out the prior low, I enter a short and I set my stop up here. Does everybody see that? No, I mean, these are 5-minute charts. So again, we're not giving this lots of time to this is just a day trade. So what the exercise here is looking at the first move down. Okay, the stock just came from here, that prior pivot, to this pivot. It then bounced to this level. Okay, I'm going to remove these black lines, and that gives me a very good indicator as to potential distances the stock can travel. So my targets potentially could be my 62% extension, my 100% extension, or my 162% extension, which is what these levels are. So I'm always looking to take trades at these predefined levels. Again, these are not exacts. These are just rough estimates of areas of which I want to look to take profits. I also know that as stock expands down here, and my volume comes up with a tail, just from my experience and from my training, I know the stock will probably snap back to the 8 and then the 21. Okay? So it's not necessarily that this is a hard and true thing that you have to live by. I just sometimes think that it gives good areas of predeterminations of where you want to look to take profits. So you'll hear me talk about, I took the trade here on a sell setup. I got involved with the stock right here. At the entry would be, again, I'm trying to make this as big for everybody as I can. The entry would be right here on a break of a prior bar's low at 110. My stops are up here at 110.33. I've risked 33 cents. At a very minimum, my 62% extension, I'll try and make this, my 62% extension is 109. So I've risked 30 cents. My first target is already $1 lower. So my risk reward is what? 3 to 1. I'm risking 30 cents to make $1. At a very minimum, my second target's 108.20. So I would take, again, we talk about tiering. I would take some profit here. I probably would also take some profit here. And then when I saw a bottoming tail, I would get out of the remainder of my trade. That is tiering out. No. The sell setup here, again, this is just for seminar conversational purposes. The sell setup is when I have a clearly defined downtrend in my moving averages. I'm trading a snapback into the averages. I don't have that up here.
Like that first bar, big red bar, no?
Here? Well, I mean, there's no. I'm just giving you an example. There's no exact here, meaning there's no only one place to get in. Let's say you took the trade on a break of this support, which is what you're really saying. You're breaking that support, you take the breakdown trade. This is the breakdown trade. You are right, and this is the bar that breaks down out of the range. You could set your stops here. Let's say you don't see that or you don't take that. This is also another way to get involved on a snapback here into a declining moving average. And sometimes I prefer these trades because they're just easier to see. And I know that I'm trading with the momentum working for my favor versus up here I don't have that. You have to anticipate that happening. If you don't see that happen and it's now down here and you say, okay, well, did I miss my trade? No, you didn't miss your trade. You just have to wait for an opportunity for a sell setup back into a moving average. And then you can use different methodologies of extensions as to set targets. When you get involved with the stock, hypothetically, right here, at that black line, there's no way to guarantee yourself, well, where is this stock going to go? Okay, and this is where my tool comes into play. We talk about my bar replay tool, right? So I get involved with the stock right here. Okay, so follow along. So I get involved with the stock, okay? The stock has broken down. My moving averages have now convincingly broken down. There's my snapback into my moving average. Does everybody see that on the far right of the screen? I now get involved. I've entered the trade. I have a 3-bar snapback into a declining 8-period MA. It tails down. I now get a bar that takes out a prior bar's low. I enter. My stop is now up here at 110, whatever this high point is, 110.30, 110.35, whatever that price is. Where is the stock going to go? Well, when I look left, I have support and resistance analysis. I can say that I have support down here. How do I know that? I've seen it turn up here, and I've seen it turn up here. Okay? 1, 2. 109 is an area that I know that I want to look to take profits. Okay? I can also use my extension tool, which I've done. So that was my first move down. That was my bounce. My 62% extension also happens to be 109. And now I have now taken profits at 109, and I have also broken convincingly through that support level, telling me the stock is probably going to continue lower. It snaps back here. Notice the snapback. You have that big breakdown bar. You've just covered some of your trade. It now snaps back to the moving average and goes lower. There's your bottoming tail with your big volume, and the trade is over. Okay, so when you day trade, you do need to be armed with strategy. You do need to have tools that you know how to use, whether it's support and resistance, or it's fib extensions, or it's using your moving averages to understand that making a good trade isn't about getting lucky. It's about being able to identify what a good trade looks like. Okay, you wait for your declining moving averages. Okay, you wait for your snapbacks. You use support and resistance. And even if you had taken the whole profit at 109 and it goes to 107, it's a good trade. Your risk reward was still very much in your favor. Okay, so that is how we use extensions. Setting targets, moving averages. So this is basically using your moving averages to set targets, which we've talked about. This is really the reversion to the mean trade. So when a stock becomes extended off of the averages, we generally will look to trade it counter to the direction. So in this particular slide, what you see on the left is stock gaps down. Okay, you have a stock that is gapped down significantly. At the time it gaps down and where it opens at $53, it is very far off the moving averages. The stock puts in a green bar, and aggressive traders will then look to buy a break of that first 5-minute bar high, with the stop being the low. Okay, this is a aggressive gap trade. You are basically trading long counter to the, even though the stock has traveled down, you are trading for a snapback to the moving averages. Look to the chart to the right. Notice how the stock trades right back to the first target, which is right when it catches up to the 8-period moving average, and then that second target would be the 21 EMA, and you would be out of your trade. What you are doing is reverting back to the mean, giving the stock a chance to catch up or have the moving averages catch up to the price of that stock. And in this particular example, this is something you see off of gap type situations in the morning for active, aggressive intraday traders. Okay, it's a 5-minute setup where you are basically buying or selling a break of the first 5-minute bars high or low, using that high or low as a stop for a trade back to the MAs. So if you hear traders buying gaps down, generally they'll look to take a trade back to the moving average. Okay, the picture on the left, intraday the stock expands all the way to the upside, very, very strong, rallies all the way up, tails down, very far off the MAs. Notice how far off the 21 it is. You can take an entry for a counter trend trade. Again, these are 3-minute charts you're looking at, so you're talking about execution time frames or quick active trades. How to evaluate an entry. Rallies all the way up, 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 tails down, takes out that low. You enter. That's your stop. What are you looking for? You're looking for a trade back to the moving averages. In this particular example, you can see how fast that occurs. Target 1 is the 8. Target 2 is the 21. Okay? It's just another tactic that traders can use for a target for a trade. Most of these trades are going to be intraday. We talk about the measured move. This is basically the pattern type trade where you're using a predefined distance and have that distance become the expected outcome of another move. We also call this the ABC trade, where A and C are the same distance. So each leg the first leg of this picture is leg A, the pullback is B, and the third part is C. A and C are basically the same distance. So in this particular picture, we have a diagram where you show a chart that has rallied from 40 to 41. It has pulled back to 40.50, which is a 50% retracement. So the distance from the first move was $1. It pulls back 50 cents. It then gives you a buy setup, and it rallies another $1. Okay. Again, this is just another way to make a determination about a potential profit target. Does it mean it has to go $1? No, it does not mean it has to go $1. These are all just expected outcomes. So that you are prepared that if the trade goes to that price, you know exactly as per your plan that that is an area you want to look to be a seller or take profits. This is an example of a that pattern that we just covered, the measured move, where you see in the highlighted yellow area, a stock rallies up into the 21, it pulls back into the 8, it looks like a catch play is developing, it's stuck between the two averages, and again, that first leg up is also the same distance as that second leg up. So A up, B down, C up, where C and A are also the same distance. It also happens to rally into where? A 200 moving average. There is a lot of harmony in what you see, meaning you're going to see trades have the same distances into moving averages that have equal distances on each side. We call that, I call that harmony, meaning the inbound and the outbound are basically the same distance. Now, it's not really that important, but it's just an expectation. So you could say if you were long this trade as a buy setup or a catch play, that you would then, your target would be the moving average above you, or it would be the distance of the first leg. Or you could even throw in your extensions. A 100% extension and a measured move are the same thing. Does that make sense? A 100% extension and a measured move are the same thing. Let's go back to our charts for a second. A 100% extension, which we determined down here was 108.25, is basically, let me remove all these lines. Okay. The first distance traveled was from here to here, right? Here to here. Stock went down that distance, right? it then bounced to here, right? This distance is your 100% extension. So what we say is A down, B up, and C down are the same. This is a 100% extension of this distance. Okay? So that's what we're saying about the measured move and the 100% fib extension are basically the same thing. Okay, again, more measured move, where you see the stock breakdown, the chart on the left, you see a $1.75 breakdown in the morning under its moving average. It snaps back. After selling off hard, the stock makes a brief pause before its continuation. It snaps back into a declining moving average. You see a sell setup when this red bar right here takes out the prior bar's low. You get involved in the short side, and you have another $1.75 move down to the lows right here. A low is set after a second push into a measured move target. The measured move is basically the opening range breakdown, the $1.75 breakdown. Okay? And again, you have these are just more examples, but to go through it, you have a buy setup that happens here. Stock rallies up, pulls back to the 21. You buy it on a buy setup. It fails. You get stopped out. See this red bar? It stops you out. Notice what happened. Because it's a failed setup, the stock implodes. Everybody that was now long is now selling. Generally, that's why you see these stocks break down rather rapidly. Now the moving averages have convincingly turned down. It snaps back into its 8. It tails down. It's now a sell setup, and it trades down another $3. So again, what it says here is a fail buy setup, meaning your buy setup failed. It causes a $3 breakdown. It then bounces and gives you another $3 trade lower. And again, you see the same concept here where a stock makes a top, pulls back, retests that top, and fails. It then bounces into your moving average, which then catches it and pushes it another $2 down. Again, more measured moves. This is, again, a daily chart, not an intraday chart, but the concept applies. The concept applies on all time frames. Whether you're looking at 5-minute charts or daily charts, you're still seeing those trades take place. The stock gaps down in this chart. You can see a large gap down right here. That causes sellers to step in and push the price down. Okay, you can see it consolidates here for a 2-bar consolidation under its moving average and continues lower. Again, this first move, this bounce, and this second move are equidistant. The measured move, down, up, down, where this first move and this second move are the same distance. That's all we're trying to show here. Okay? No. No. Again, I don't want to spend too much time here because I don't think it's super important. I'd rather you, instead of trying to calculate, well, the first move was $1, so the second move has to be $1, I'd rather you use your tactics more so than that approach. Okay? When I say tactics, I mean trading because you had covering because you had a bottoming tail, or a large volume bar, or your moving average was taken out, or something along those lines, than trying to always try and get a measured move trade. Advanced topics. Now we're going to get into gaps, which I think are fairly really confusing or can be quite problematic for those that are, newer to trading. Gaps can be a really, really great trading approach. Gap trades will generally take place in the first 30 to 45 minutes of a trading day. So you have to be prepared, if you are a day trader, on how to trade a gap right from the get-go. So what is a gap? A gap occurs when the opening price of a stock is different than its prior day's close. The area between the opening price and the prior day's close is the gap, which is typically measured in price and or percentage. So, for example, in the picture on the left, we have a gap up. The stock closed the prior day at the top of that green bar and opened the next day significantly higher, causing this hole in the chart where there was actually no trade, price was not traded, causing a gap. We call them a hole or a void or a gap. Okay. Again, a gap down, stock closes here and opens here, creating a hole in our chart. The question in the chat is, would you use the fact that everybody got caught ever change your targets? No, I'm not sure I understand what you're asking me, and everybody got caught. I don't think that everybody got caught is definitely a trading rationale. I think targets are effective tools when you look at them for what they are. You're trading your individual patterns in your charts. For instance, I think the question really refers back to the chart about a failed buy setup. So if you take a buy setup and it fails, and you get stopped out, and that buy setup all of a sudden becomes an exponential counter-directional move, or a reversal, is what I'm trying to say. Try to take the logic of, okay, we had a price reversal, now your moving averages have turned down, and you're going to want to trade a snapback into the moving averages. I think when you try and justify trades like everybody got caught, or this sort of mentality that people take on, which is, oh, they got me, or they, you know what I'm talking about here, where, people take that mentality of the market got them, or somebody did something wrong to them, or they did this, or them did that. You probably are going to take the rational logic out of what you're doing. Okay. What causes a gap? Gaps are caused by news that can happen to a certain stock or sector. For example, a gap can occur because of an upgrade, a downgrade, an earnings release, or some sort of broader market news. It's not necessary to know the exact reason why a gap is occurring to be able to exploit high odds trading opportunities with the gap strategy. So does it really matter if stock XYZ gaps up, let's say $1 or 10% overnight because of a rumor or an earnings report or an upgrade or downgrade? Is really not relevant to the technical trader. What's relevant is how far away from the moving averages is it? What does support and resistance look like at that current time? Et cetera, et cetera, et cetera. The more you try and focus on the external factor, the more it creates an opinion as to what the stock will or should do. Stock XYZ gaps up $1 because there was an article on in the journal about the management buying back whatever, or laying off, shutting down a plant in Malaysia, or something that you know very little about. It can inherently create a bias as to the stock will or should have some sort of result. And the reality of it is technical traders need to focus on the movement of price. The movement of price is how we make our money, not the movement of news. It's not our job to decipher or determine what the news will do to the stock. A lot of times you'll see a stock do counter to what you think it should do. Okay. Types of gaps. There's 3 types. A continuation. So these gaps occur during and in the direction of an ongoing trend and are generally viewed as confirmation of the trend's strength. They typically bring in above average volume. So a stock is directionally moving up Okay, everybody think about the Apple chart, directionally moving up, and during its trend up, it continually gaps higher from one day to the next. Those are continuation gaps. They're continuing the current direction of the trade. Professional gaps, or what we call reversal gaps, these gaps occur as a reversal against the trend and tend to deliver significant shock value. They can be so powerful that they may trap buyers or sellers to cause extreme emotions and reverse in the direction of the stock's short to intermediate term trend. Typically, they bring in high volume. And an exhaustion gap, what we call a novice gap, gaps occur after and in the direction of a strong one-directional multi-day move, typically ending the short-term trend. Ideally, they are gapping far away or into the 21 EMA or into an area of prior support and resistance. They typically bring in high volume. Let's take a look. Continuation gap. Again, so you can see a uptrend, a stock in an uptrend above its 21 EMA, where you get pullbacks. And pullbacks are consistently bought, and you get a continuation gap in the direction of the trend. And you can see that it opens and it continues higher. Stocks in a downtrend, again, it gaps down and continues in the direction of the current trend below the moving average. Well, we'll get into the trade. This is just a type of gap. Okay. Again, more examples of continuation gaps on daily charts. So you can see the overall stocks that are trending up above the 8 and the 21, and they continue in the direction. Both on the right and the left, an example of a continuation gap in an uptrend and a continuation gap in a downtrend. Reversal gaps. So you can see a stock is in a short-term downtrend, multi-day decline. It closes on the low. The next day, all of a sudden, you come in, you say, oh my God, how did this happen? The stock is now trading right back where it was 4 days ago up here. Causes a reversal. There's shock and awe here. Again, same thing. Stock has a multi-bar uptrend move, multi-day upward move. All of a sudden, it gaps down and is trading back into the level it was in the preceding days. So these reversal gaps, okay? These are examples of what we're talking about. So you get a multi-bar decline. The stock is now closed below its moving averages. Okay, you can see that uptrend is now not over, but something has greatly changed here. The next thing you know, you come in one day and the stock is all the way gapped up here. Those create reversals. Okay, we had a short-term move down. We gapped up. It caused the stock to then rally all the way back up. Okay, right here, a move down. You get a snapback into the moving average, a 3 to 4 day up move. Next thing you know, the stock is gapped down and causes the stock to go much, much lower. You see these all the time. And the last gap is the exhaustion gap, where you get a multi-day run. Multi-day run, and the stock just continues to gap significantly higher. We call these exhaustion gaps, and we'll explain why as we show examples. Okay. Usually these are the type of trades that are very far extended off their moving averages, and they will be the beginning of that reversion to the mean snapback trade. Okay, and I'm going to show you an example. Okay, down here, we had a stock that gapped down from the prior day's close. The prior day's close was right here. The next day we opened down here. We opened at prior support, and the stock reverted back to the mean all the way up into the moving average. Does everybody see that? Okay. So these are very powerful exhaustion gaps. Stock that gaps greatly off its moving average, reverts back to the mean. Okay. Yeah. This chart as a no, I'm just showing you an example of that reversion to the mean trade. So that's, and we're going to go through gaps. Okay. Usually you'll see these types of trades break away and they will snap back. So in this particular example, stock has had a really, really big run. It's far off the MAs, and you'll start to see it come off. These are trades that day traders tend to love. Okay. Here's an example of the exhaustion gap, a multi-day rally and a gap away from the 21. Notice how far the stock is from the 21 when it opens up all the way up here. Gap open. Here was the prior day's close. It opened up here, and it begins to sell off. Okay. A multi-day decline and a gap down into the 21 EMA and price support. Novice exhaustion gap open. Again, multi-day decline, gaps down into support, causes the gap to turn. Coming in with a gap bias, or determining gap bias. We must first understand that the three most common misconceptions many traders have regarding gaps are that all gaps tend to be filled, a gap up is bullish and a gap down is bearish. Any news helps determine if a gap is bullish or bearish. T3 Live use a rating system to determine the bias of a gap. Okay, so let's go over that. The gap checklist. Again, mark the page. Is the stock gapping over or under daily support or resistance? So when you look at the gap, we look at our daily charts, again our analytical time frame, to determine is the gap at support or near support. Okay? What has happened on the daily short-term pattern? Does the gap have relative strength or relative weakness in correlation with the broader market? Meaning, is the stock gapping down while the market is gapping up? That would be relatively weak. Is the stock gapping up while the market is gapping down? That would be relatively strong. Is the size of the gap average, or is it excessive? Okay. Is the size of the gap average, or is it excessive and destroy the technical pattern? Meaning, does it completely change the trend of the stock? You have a stock that's in a nice uptrend, it's above all its moving averages. Now it comes in one day and it's gapped down significantly below both its 8 and its 21. That changes the landscape of that uptrend. Okay. Bullish and bearish points are awarded according to the checklist. The more points awarded to the bulls, the more bullish the bias, and vice versa. A 3 to 4 star gap are only the gaps that create anything strong enough to create a strong enough bias to determine if the odds are favorable. Anything less than 3 stars is best to just leave it alone. So if it's gapping over or under support and resistance, that's over resistance would be 1 star to the bulls. Under support would be 1 star to the bears. So if a stock, let's say as an example, we'll show pictures obviously. Let's say there's major support at the stock at $15 and the stock is gapped down and it's opening at $14.50. It is under support, 1 star to the bears. Okay. A stock has major resistance just above at $50 as an example. You come in and the stock is trading at $51. It's above resistance, 1 star to the bulls. Short-term pattern, we look at the gap in relation to the last 1 to 3 days. If a strong bullish prior day's bar is erased 100% of the open, many traders are trapped and on the wrong side of the trade. This can spark a snowball effect. The stronger the prior day's bar, the greater the spark. Okay, we'll look at a picture of that. So yesterday, as an example, stock puts in a gigantic green bar. Huge up day. You come in the next day, Monday morning you come in, and it's gapped below the prior day's low. So it has essentially eliminated whatever happened on Friday, as an example. That creates a reversal. So a gap over a solid bearish bar is 1 star to the bulls. So if it's a super weak day and you come in and it's gapped above the prior high's day, and again we'll look at pictures so you can see. Relative strength to weakness, if the market is gapping up, if the market's gapping down a considerable amount and the stock is gapping up, 1 star to the bulls. Vice versa, 1 star to the bears. If the market is opening flat or neutral and a stock is gapping a significant amount, 1 star in the direction of the gap. So if the market's basically flat, but you come in and your stock is up 5% pre-market, 1 star to the bulls. Okay. If the market and the stock are gapping in the same direction, it's a 0.5 star in the direction of the gap. Okay. Now, do you really have to go and create a checklist? No. You don't have to go and create some sort of checklist. You can if you want. This is really just criteria that we're trying to use to help make or determine a bias towards a gap so as to make a tradable decision. Do I really want you to go and make a pretty checklist? Only if you feel like it helps you. Rating a gap, the size of the gap. Ideally, the stock should be gapping just enough to create the spark. Generally, just enough to erase a prior bar and or prior bar support resistance. However, if the gap is erasing a significant wide range big body bar, the more the better. In this case, it only becomes excessive if the gap erases the prior bar and support or resistance excessively. Again, I know that I'm reading this on the faster side, so it's hard to probably process. Pictures will do us a lot more, a lot better of a service. An exhaustion gap has exception to size. As the greater the size of the gap, the better, as long as it does not become excessive. An excessive gap is one that destroys the technical pattern of the chart. Okay. If the size of the gap is just enough to create a spark, then it's 1 star in the direction of the gap. If the size of the gap is excessive and destroys the technical pattern, then all rating and gap strategies are considered null and void. Does everybody understand what that last sentence means? If the size of the gap is excessive and destroys the technical pattern, then all rating and gap strategies are void. So, for instance, you're long a stock. Right, exactly. So you're long a stock and or whatever, you're in a stock and it closes one day at $50 for argument's sake, and some news comes out and the stock, the company's fraudulent, they cook the books, whatever the news is, and the stock is now trading at $2 the next day, or it's halted and it opens up at, I'm just making up an extreme example, and then stock's lost 80% of its value. The technical chart has been destroyed. All gap strategies are null and void. That's right. Novice exhaustion 4-star checklist. Again, this is what we just went up, so you can sort of read over this or mark it off, as it is a good reference point when you are looking at gaps pre-market. Okay. So a 4-star gap. A 4-star novice or exhaustion gap. And again, if you can't remember what an exhaustion gap is, just go back a couple of slides and take a quick look. An exhaustion gap is a gap where the stock has had a multi-bar directional move that becomes very far extended off the MAs. So, again, the 4-star rating into resistance, okay, which is not shown. Okay, in this picture we couldn't fit it all in, so the stock is gapping into resistance, meaning that to the left, the 22, where you can see where it opened, had acted as prior resistance. Again, it's not shown in this picture. So it's into resistance. So that's 1 star, right? It's 1 star. The short-term pattern is intact, meaning it's still in its uptrend. Again, 1 star to the as a novice, as an exhaustion gap. So we're trying to determine if this is a novice or an exhaustion gap, and the way we do it is by asking ourselves these questions. Is the stock gapping into resistance? Yes, it is. 1 star for the bears. Is the stock in a short-term uptrend, 1 star to the bears because we know that it's very far extended off the moving averages. You look at where it's opening, look at your moving averages, it is very far off. That's actually a star to the bears because it's on a multi-bar run and is probably due for a rest. Think about trading or uptrends like running a marathon, which is going on today in New York right around us. If I were to run a marathon, well, A, it wouldn't be that pretty. But B, I would probably run for as far of a distance as I could until I became exhausted. In my case, probably. Hey. Oh, she said half a block for me. I said I could at least get 3 blocks. But the point I'm trying to make here is you go as far, and stocks will run as far and as fast as they can until they become tired, at which point that is the reversion to the mean trade, where they will probably rest or pull back into their moving averages before they resume their marathon in trending stocks. Okay, we love those trades. Relative strength, is the market gapped up, not shown, 1 star to the bear. Obviously, we can't show you that in this picture, but in this case, it's 1 star for the bears. The market was gapping. I don't know what the market was gapping here because it's not shown, but he has it as we have it as 1 star for the bears, and the size of the gap, 1 star, as it is a nice size gap. When we talk about the size of the gap, and we'll get into the actual trading part in a little bit. We like gaps that are relatively far away. Okay. This is a reversal gap. Okay. You can see the stock closes the day on the low right here. Okay. And you can see the next day it's gapped up above the prior day's high. Notice how the stock put in a large red bar right here. The stock put in a very large red bar. The next day, it's gapped up right back to the highs. That's that professional reversal gap. Okay? Does everybody see that? This red bar, this is a daily chart. Okay, you can see on the previous day the stock had closed very, very weak, putting in a very large red bar. Sellers dominated the trade. The next day we come back in and the stock is gapped up. It's opening right at the prior day's high. It has eliminated basically the entire day's worth of trading. That creates reversals. Look at how the stock trades back higher 2 days later and even that day. Okay, it's a reversal gap strategy. So the stock is over resistance. The stock has taken out the prior day's high. It's a relatively large gap, and the market was flat. So it had good relative strength because it was gapping up and the market was flat. Okay, now let's get into the actual good part, which is the gap entry and the gap strategies. The 3 or 5 minute high-low. This method works best for stocks that show heavy strength or weakness off of the open. If a stock has a 4-star bullish gap, T3 traders wait for the first 3 or 5 minute bar to close. Once that bar closes, we say prince. Prince closes is basically the same thing. If the very next bar trades above that bar's high, the bias is validated and the stock can be entered with a stop under the low of the day. The first buy or sell setup, again, this is the same concept, but instead of waiting for the first 5 minute bar or 3 minute bar to close, we're actually buying a pullback or shorting a bounce into moving averages.
Does it matter what gap it is?
Well, we'll show you. Yeah, I mean, no, it doesn't really matter what gap it is, but you'll see the trades in a few. The method works best with those that don't see heavy conviction off the open. So if you're not willing to commit to a trade 3 minutes into the day or 5 minutes into the day, and you'd rather see it give you a directional move and then buy a pullback or short a bounce, that's the strategy that we also employ. Okay, the 5-minute buy, the 5-minute high or low. You enter along basically when it trades through its first 5-minute bar high or 5-minute bar low, with a stop at the low of the day or the high of the day, depending. Okay. Using the 3-minute chart will generally offer a lower risk and greater reward to risk ratio in comparison to using the 5-minute entry. However, the 3-minute entry is more aggressive and has a higher probability of being stopped out because that can cause a premature stop out. So what we're saying here is that if you're going to trade a gap based off of a 5 or a 3-minute bar, it's an aggressive strategy. You're basically committing to a long or short position within minutes after the open. So the way to protect our risk is to use that first 3 or 5-minute bar as also our stop. However, if you are using a 3-minute entry strategy, you are subject to getting stopped out potentially easier than using a 5-minute chart.
Still using the analytical.
You're using them to create a bias as to direction. But again, this is an aggressive day trading gap strategy. This is something only for intraday traders. Only. Okay? 3 or 5-minute high. Okay, so we can see that in the picture to the left, the stock has gapped above its current base. You can see it's gapping out of a range. It's above its 200. It's above its 8. It's above its 21. Okay? Aggressive traders can look to buy a long through the first 3 or 5-minute bar high with a stop right here, and you can see you get that directional move. It doesn't really matter what kind of gap it is. What really matters is don't concern yourself with what kind of gap is this. Is this a professional? Is this a novice? That's not important. What's important is actually the trade that you take depending on the type of gap, and that's what we're going to cover now. It's really the actual. This is where it gets confusing. I think traders tend to focus on what type of gap is this. What type of gap it is really irrelevant. What is the trade is what's relevant, because the trade is what makes you money. So being able to figure out how you want to position yourself is what's really important here. Being able to say, oh, this is a professional gap, isn't really that important. Let's go back a step, okay? We talk about this slide where you can see a multi-bar decline right here. And the stock the previous day it puts in a big red bar. The next day, you gap up above the prior day's high. Immediately, you have to think to yourself, not this is a professional gap. You have to think to yourself, the market just eliminated a prior day's bar. This is going to cause a reversal of price. You should be looking and thinking, my bias in this trade is to the long side. Even though the stock is in a downtrend, see your downtrend, and it's below the 8 and it's below the 21, the reality of it is the gap is going to or should cause some sort of reversal. Look at what happened. That's right. Because it's taken out a prior day's, it's eliminated. Again, let's go back to the professional gap. Remember, this is the professional reversal gap where it basically eliminates a short-term trend. You have a short-term downtrend, the stock gaps up, it completely has eliminated that short-term trend, and it causes a reversal. It's panic. I was short, oh my God, all my profits are gone, I'm now on a loss, what do? I have to cover, the stock reverses its price.
And just, I know you're using this in an intraday, but if you looked at the daily, could you see that the trend was broken or no? You would only see that on the...
Well, we're really looking at short-term trends. We're really looking at short-term trends. Okay? So when we look at this slide, right, the short-term trend here had been down. The last 5, 6, 7 trading days have been down. Now it opens up here. What's going to happen? Panic. Oh my God, I was short. Holy crap, I have to cover it. Now I have to buy it. It causes the reversal. Okay? Okay, so we just did the 3 or 5 minute bar entry. So you come in and you see the stock is gapped up here. It closed down here. It gapped up here. Right? You can see, what's your thought process? Well, the stock's up here. Okay, it's pretty far off the 21. You wait for that first 5 minute bar to close. You take a short trade. When it breaks that low, you put your stop there. It trades back to the 8 and back to the 21, and you cover. Okay? I'd cover at the 8, and then I'd cover at the 21. Again, another entry technique is the buy and sell setup. Okay, so depending on what's happening, okay, so in this particular picture, you can see the prior day's close was down here. The stock gaps open all the way up here. It pulls back 60% retracement. 60% of the retracement from the prior day's close to the open. Or 50, sorry, I meant to say 50. So the stock retraces 50% of the gap. It tails back up. You see that bottoming tail. It takes out a prior day's high. You can put your stops in, and it's just like a regular trade. Think about, the way I always tell traders about gaps, think about the gap as if it's a giant green bar. Okay, what is this gap? It's basically the price has gone from here, the close, to here, the open. Think about that visually as if it's a gigantic green bar, or red if it's a gap down. Okay, so look at the picture to the right. Again, think about that as if it's a giant red bar. It'll help you in your thought process to visually imagine, what has happened, because it makes sense. So if I were to say the picture on the right, okay, you have this gigantic red bar down, it retraces 32%, it's a shallow retracement. Now all of a sudden your moving averages have caught up to the price of the stock, and it turns down, and we'll show you more.
But this is just another entry. So
that's right. This is just another entry technique. Okay, so here, the picture to the left, this is a perfect example. You have this big gap up. Visually, that's what? It's a big green bar. That stock just went from 38.80 all the way to 39.60. It's a gigantic green bar. That's how I always, imagine that trade. And the question in the chat is, do you use pre-market prices in determining whether it's a gap and considering taking a position before the opening, or is that a trap? The only time I ever consider looking at pre-market prices is when the stock does exceptionally heavy volume pre-market. So the only times generally you'll see that is when there is some sort of earnings release or some sort of major news that is causing chaos or extreme movement in price, and the stock is trading lots of shares pre-market. If it's a normal gap and you come in and the stock's up, let's say 0.5%, and it's done a few hundred shares overnight, or 1,000 shares, or a few thousand shares, or a relatively nominal amount of volume, I will not consider looking at pre-market prices. There's not enough liquidity there to support what's happened. That's my rule of thumb. So, for instance, if I look at, let's say IBM as an example has earnings on Friday, and I come in Friday morning, and I come in, it's 8 o'clock in the morning, and the stock's already traded, 1 million shares pre-market, and it's up $4. I will then consider looking at pre-market price movement, because there's liquidity there. There's actual buyers and sellers that are there changing hands, and I can look for opportunity using those potential prices. Okay. So the buy and sell setup here, again, you have a gap in the picture to the left. It gaps up. It gives you that 3-bar pullback, and you can buy on a break of a prior bar's high. Notice the high. High, lower high, a trigger long when this 4th bar takes out the 3rd bar's high. That doesn't matter. Because what matters here is that your stop is in place. the bottom of this red bar would essentially be your stop. So you're risking a very small amount. This big green bar, which represents the gap, gives you a very shallow pullback. It's a bull flag. You see that visually? And then it gives you that next trade up. Again, look at the time frames we're talking about here, 5-minute charts and 3-minute charts. Most of your gap trading, if you choose to trade gaps, will come off of very small time frames. Why? Because you don't have time to wait for 13-minute charts to set up, because by the time the 13-minute chart sets up, the gap has already been traded and filled, or the strategy is already over. It's a very aggressive, quick, opportunistic type of trade that will happen within the first 30 to 45 minutes. So your only defense is to use a small time frame. It's not that it's advanced. I mean, listen, it's not that it's advanced. You have to be a good, rapid decision maker. So if that means advanced, then that means advanced. Yeah. Remember, you're going to see the most volatility in the first 30 to 45 minutes of the day, which means prices move at a very rapid pace. So you have to be able to make decisions rapidly. Same concept in the picture to the right. You have a gap down. That gap down visually creates a large red bar. You get a 3-bar pullback into a declining MA. That's a sell setup, and that causes the stock to go lower. Relative strength. Relative strength is relative strength is one of those strategies that day traders love. They gravitate to it. So the question in the chat earlier was about the S&P futures. Do you trade the S&P futures? Do you take the market in consideration with the stock that you're trading? And this is where that comes into play. Relative strength is a core strategy used across different time frames. It measures the weakness of a stock versus an index or other stocks within the same sector. A stock that is relatively strong displays a positive divergence from the overall market or sector. A stock that is relatively weak displays a negative divergence from the overall market or sector. Basically, the market is strong and your stock is declining in price. That's a divergence. If the market becomes weak, I would suspect your stock will just greatly enhance the weakness that it already has, and vice versa. For instance, the market is making new lows and has begun a downtrend while stock ABC is trending sideways. Stock ABC is relatively strong. It's going sideways while the market is going down. If the market were to turn back up, stock ABC would probably break out and trade higher. Stock is also strong if it is making new highs while the market is trending sideways. So just think about it in terms of a correlation. Conversely, a weak stock would make new lows in a sideways trending market or would trend sideways during an uptrending market. The concept can be applied on a short or long-term basis. Like most other indicators, it carries more weight on a longer time frame. If a stock is able to hold its price or go up during a prolonged bear market, it should see significant price appreciation once the market turns back up. Traders who spot divergence as it develops will be the first on board in a winning trade. The most money is always made buying relatively strong stocks and shorting relatively weak stocks. Pretty simple. Okay, in theory, it's pretty simple. I'll tell you who's made a whole career out of this is Mr. Scott Redler. Majority of what he does is finding relatively, intraday, if he's day trading, finding relatively strong stocks to the market and staying with those. And then he's looking, when he finds that relative strength, he'll then use his technique to to look for buy setups into rising MAs. I mean, it really is his go-to trading strategy, and he is as consistent gets. Okay. And a lot of times on T3 Radio or the website on the virtual trading floor, you'll hear guys talk about, oh, it's acting well or it's acting poorly. That's what they're saying is basically the stock is relatively strong to the market or relatively weak to the market. The stock, the trading floor, the virtual trading floor. If a stock is breaking down and making new pivot lows while the market is going sideways or going up, that's a stock that is relatively weak to the market. Okay. So on the chart to the left, you have the SPYs, which we use as our sort of market instrument of the S&P futures. Although you don't have to use the SPYs, you can use the E-minis. But it's generally the most widely watched broader market index. So you see the SPY sell-off in the morning before rebounding through lunch. Well, the charts are, I mean, I don't care what pictures you have. You could have different charts. You have,
I know, but in terms of keeping it.
yeah. I have to go back. I don't know why maybe I took the wrong. Okay, well, still, I want you to, the concept here is is just explaining the relative strength. Again, the spiders, you see a morning sell-off. They are downtrending under their MAs, but Monsanto on the right on the same day at the same time begins an uptrend. You can see the moving averages cross. The stock pulls back to the 21 and then ignites. Again, when the market rebounds through lunch, you can see at 12 o'clock the market rebounds and starts to turn back up. At 12 o'clock, look what happens to Monsanto. Okay? All that is that concept. You know, looking for divergences in the market can be a fairly low-risk way to identify a stock that could potentially break out or break down. Same concept here with the Qs. The Qs gap down, okay? So already you have divergence because the Qs are gapping down and the stock to the right, which happens to be SanDisk, is gapping up. So you can see that divergence in the gap. You have a stock that's gapping up versus a market that's gapping down. Okay? Well, look at the gap. You have the Qs are gapping down and SanDisk is gapping up. Okay, so you already have that divergence or that correlation, that differentiation built in. And when the Qs actually finally turn up, at some point they find a short-term low, they're extended off the MAs, they snap back, SanDisk is already well off and running. Okay? Again, these are just more examples of this correlation here between relative weakness. The spiders are pretty much rallying all day, and the stock to the right is breaking down. Okay. Yeah, I know. I'm not sure why they were taken out. I'm not sure. I'll have to find out. I'll resolve all the book issues. Those I won't. I'll figure it out. Acceleration and deceleration.
Yeah, that's the one that emailed you. The one that Eamon gave me the slides afterwards.
Okay, relative strength?
Yeah. No, it's acceleration.
Oh, great.
Yeah, acceleration, deceleration. And again, this is really just all this is we talk about pace. We talked about it yesterday. It's a different way of showing it. Pace increases. So think about this stock, okay, and what I want you to imagine, the reason we put this in is because what I want you to imagine is, what do you think your moving averages, your 8 and your 21, look like in this chart? They're turning down, and the stock is probably sitting under either its 8 or its 21 until it gets to the point where it just extends, pace starts to increase, the slope starts to increase, and it becomes very far extended off the MAs, volume comes up, and then it would snap back. Okay, that's how that occurs.
So is there any so you're looking at the volume as relevant?
Well, the volume only becomes relevant towards the end of the trade when we get that volume spike, and then the snapback occurs. But what I want to show here is how at pace, the stock can slowly start to bend until it just starts to waterfall and break down. Do you see that occurring?
Yeah.
See how it's accelerating?
Very gentle
That's how a lot of trades will start like this. They'll start to slowly grind down until everybody's like, wow, this thing's really weak, and then, it starts to break down and so on and so forth. And then we call that acceleration or deceleration with slope and volume. As the stock starts to accelerate to a direction, you'll generally see volume start to pick up a little bit. All that's basically showing you is that fear is starting to set in. Yeah. Again, these are just advanced concepts. Okay, so let's look at this chart where we have a decelerating trend. You can see how fast it starts to break down, and then all of a sudden the slope of the breakdown starts to decrease. So decreasing slope and volume. You see how it's breaking down, the volume's getting heavier, and then all of a sudden it starts to slow down and volume basically falls off. That's right. That's a sign that the stock could potentially bounce. Again, these are all concepts. This is not anything that you would actually make trades off of. This is just stuff that when you look at a chart, you're not just looking solely at your moving averages. You're actually looking at the pace and the slope of an acceleration or a deceleration. That's all this really is. That's right. Right. You always want to, if, for instance, you're on the short side of a trade and it starts to break down and the pace starts to increase and the volume starts to increase, you have to be thinking about taking profits. You want to cover into accelerated moves. You want to sell your longs into accelerated moves. Okay. So again, we have using acceleration and deceleration for playing trend reversals and failures. Again, in the chart to the left, he's highlighted what's a potential double top play, and you can see how the decreasing slope and decreasing volume, when it trades back up, right here as the stock trades back up, you can see the slope at which it trades and the volume at which it trades both decrease relative to the prior up move. That's a signal that the stock could potentially reverse. Okay. Again, decreasing volume here, decreasing slope right here are a sign that the stock is going to reverse its downward movement. Right? Now it's above its 21 MA. You can see that it's never closed above. It's closed above its 21A. So even if you weren't looking at slope and volume, you would say, hey, it closed above its 21 MA. The next bar took out that high. Remember that technique? That's your clue to get out of the trade. Again, all this stuff is just showing you what you've already learned in a different format. So you're not solely relying on moving averages, but I personally think that moving averages to me are always a better gauge. Because what traders do when we teach, acceleration or deceleration is that they're constantly looking at their volume to see if it's higher or lower than the previous volume, and a lot of that stuff just causes you to lose focus over what's important. What's important is price, the movement of price. So the reason I don't like to spend a ton of time on this is because I don't want you sitting there trying to draw lines on your volume bars to make decisions about, well, is this going to... Use your other information, use your patterns and your moving averages to help you make informed decisions in your pivots. All right, so let's take a break for lunch. It's 12:20, 12:25, 12:30. Let's resume at like 10 after 1, 5 after 1. 1:15? Yeah, that's fine. 1:15.
It's really hard to chew those salads.
Okay, so let's resume at 1:15. That's about 45 minutes, a little bit more for lunch. I know it's a lot to digest, but I do want to have a lot of time this afternoon to get through some like real-time charts and go over some questions that I think will be a lot more helpful. Okay, so I will see you back at 1:15.